seasonal illness. But luckily, you're not here to listen to me. We are here to really have a fantastic discussion with our distinguished panel. And let me just introduce the panel before we get into the substance of the afternoon. So I'm just going to introduce everyone in the order that they appear on my screen. So first of all, we have Anne de Lanversin, who is the CEO of Generali Global Pension. Welcome, Anne. Ambrogio Rinaldi, who has a number of positions. He's a director at COVIP, of course, the Italian pension supervisor. He's president of the International Organization of Pension Supervisors and also a member of EIOPA's Board of Supervisors. So I think we're going to get a very interesting international regulatory perspective from Ambrogio this afternoon. I'm also delighted to welcome Justin Ray. Welcome back, Justin. I think you've become a real regular at this event, and it's always a pleasure to have EIOPA present with us for these discussions. Justin, I think, as all of you will know, is head of policy at EIOPA. And last but absolutely not least, Thomas Richter, chief executive of BVI in Germany. And I think you can see with that combination of jurisdictions this afternoon, France, Germany, Italy, colleagues from the EU and international regulatory community. I'm also going to say a few words on the UK experience. We really have a very broad range of experience and expertise to talk both about the national level, but also the European policy environment. We spend a lot of time, understandably, thinking about how to protect pension savers in defined contribution pension plans, because the very nature of DC, of course, is to transfer quite a significant degree of risk to individual savers as they make provision for their retirement. What we're going to do this afternoon is we're going to think about two aspects of protection in particular. We're going to think about investment risk, and we're going to think about retirement income. And quite clearly, there is a big connection between those two. But I think it's also possible to make a distinction, particularly as the challenges of the so-called accumulation phase are often quite distinct from those that face individual citizens coming up to retirement and entering into retirement and to the end of their lives. Those two risks, of course, are two of the five that EIOPA has identified as charges, administration and governance, and the knowledge gap. I'm sure Justin will talk a little bit about this afternoon, and we're not going to constrain ourselves to just talking about investment risk and retirement income, but I think those are probably the two most significant things that regulators and industry and indeed policymakers who are setting the overall framework need to get right if we're to make a success in this very important. In this first segment, thinking about investment risk, is to start with Justin, to start with EIOPA, and just ask you, Justin, to outline where EIOPA's thinking has got to in this area. Of course, we've had the latest EIOPA advice, which has set out quite a clear set of expectations and views. So may I just hand over to you to start? I think you have a few slides, and then we're going to go around the table and think about some of these things in a national context.
Well, thank you very much, Jonathan, and good afternoon to everybody, and thank you to EFAMA for the opportunity to speak at this webinar and as part of European Retirement Week. What I'll do is don't worry, I only have 3 slides. I will go through those just kind of by way of introduction to the EIOPA landscape and the kind of shift from DB to DC in particular throughout the EU, so a little bit about demographics, and then I'll come back, if I may, Jonathan, to your question about how to protect savers from investment risk, though of course, I mean, the kind of underpinning answer is that you can't. I mean, otherwise it's not a DC scheme, but anyway, I'll come back to that. So if we just scroll down one slide, here you will see something, I don't know, Bernard, if it's possible to make it maybe a little bit bigger. This is a summary of the EU's IOP landscape. And I think it is, well, what it shows, I think, is the diversity of occupational pensions within the EU. I mean, if you look at the top line, the number of IOPs, you will see, for example, that there are, I believe, some 88,848 in Ireland, and to compare, say, with 207 in the Netherlands. In other words, 99% of all IOPs in the EU are Irish. But if you look at the bottom line, which is the size of IOP assets, you will see that although Ireland, proudly has 99% of all the IOPs, it only has 5% of the assets. The Netherlands, with 207 IOPs, has 63% of the assets. So, the landscape is diverse. You can see other countries there at the bottom with a substantial share of IOP assets, including Germany, Sweden, Italy, Belgium. So, just to kind of illustrate that. The IOP landscape is diverse. Let me say something, please, in the next slide on the shift from DB to DC. I mean, this shows whether an EU member state is defined benefit or defined contribution for a variety of countries. What you can see is that, say, for most of the Central and Eastern European countries, Poland, Slovakia, and so on, these are kind of predominantly DC. DC is dominant there. But if you compare it, say, with Germany in particular, Belgium, the Netherlands, at least at the moment, you'll see that these are kind of dominantly defined benefit countries. We can also say that the distribution is changing very quickly. I mean, something like 4% of members of EU IOPS went from DB to DC in 1 year, which, I mean, given the pace at which things normally move in pensions, this is pretty quick. And it's going to happen even quicker when the Netherlands, I mean, if the Netherlands completes its pension reforms and moves to a DC system, I mean, it will do so both for the future and for the past. And then in the EU, defined contribution will be the dominant form of pension provision. I mean, and this is a significant change compared with the past. Of course, I mean, I'm a supervisor, and from the perspective of a supervisor, I mean, DC changes the nature of the risks quite considerably. I mean, very broadly speaking, the kind of key issue goes from sustainability of the pension to its adequacy. And of course, who bears that risk? Again, very broadly, typically from the sponsor to the member. And our advice on IOP 2 kind of needs to reflect that. Let me just have one final slide on demographics. I mean, you probably know this stuff, but this shows old age dependency ratio, so the proportion of those over 64 to those between 20 and 64. The bottom line in each chart is the EU average, and I mean, I think this is very interesting. I mean, it shows that actually we're kind of only at the start of the great aging of the EU population, that there will be a dramatic increase in the dependency ratio in the kind of 20 years between 2019 and 2040. The right-hand chart, I mean, illustrates the position for the Central and Eastern European countries, because in some ways the position for them is particularly acute, but actually also highlighted could have been some of the Southern European countries as well. I mean, the EU as a whole is aging quickly, and then some EU members are going very quickly from being younger than the EU average to being kind of significantly older. And I mean, this has, of course, significant implications again for the sort of sustainability of pension systems. So I share these slides just by way of background to EIOPA's advice on IOP 2, that you've got a very diverse landscape, you've got a shift from DB to DC, you've got a lot of forthcoming challenges. In terms of your kind of how to protect savers from investment risk, as I said, I mean, inherent in a kind of DC scheme is that the risk is on individuals, and I mean, that can either be completely in terms of a pure DC scheme, or there can be some sort of elements of guarantee. But it if you are protecting savers completely from investment risk, then it's kind of unlikely to be a DC scheme. I think that what EIOPA sought to do was to reflect this shift to DC and therefore put particular emphasis on the following. It put emphasis on costs and charges, particularly in relation to reporting to the supervisor. I mean, we know this works, or rather it worked very well in the Netherlands when reporting of costs and charges became a more kind of uniform activity. There was significant reductions. And this is something that we are seeking to build on in the EIOPA advice, build on an earlier opinion, which set out sort of templates of what costs and charges should be included. We put emphasis on governance, and particular, I mean, what we say is that those who run EIOPs should know what are the risks which relate to that particular EIOP arrangement. So, I mean, that is a sentiment that applies as much to DB to DC, but we had DC particularly in mind, and maybe in particular the kind of case where an EIOP moves from being a DB EIOP to being a DC EIOP, that those who run it need to kind of understand what are the sort of new risks that their members face. We put emphasis on projections that, again, when it is the amount of pension that is variable, it is important that members receive projections of what might be their future pension, and indeed put emphasis more generally on the kind of the pension benefit statement, and that this be standardized at national level. Also put emphasis on long-term risk assessment, that one obligation of the EIOP management is to consider sort of what are the projections at a cohort level, and what are whether the investment options are suitable for the membership as a whole. So that is by way of introduction a little bit on the sort of protection of investment risk and what has been EIOPA's advice. Thank you, Jonathan. Back to you.
Thank you very much, Justin. That really frames things very nicely for the discussion. Interesting developments in Germany. The benefit model is still very much more dominant in certain countries, and Germany is one of those, in which we see a slower shift to defined contribution than we've seen certainly in some of those Central and Eastern European countries, and also the UK. But nonetheless, things are starting to change. And Thomas, I wonder if I could turn over to you to talk to us both about what's happening in the third pillar, the sort of personal pension space, as well as what has perhaps been a slightly harder transition to engineer in the second pillar through the workplace.
Oh, here I am. Thank you very much, Jonathan, and thank you for the opportunity to talk to you, and I'm very happy to do this. You were mentioning that Germany is an entirely DB country, but what does DB? What does benefit really mean? Back in the old days, benefit meant that a certain return of the pension investment has been guaranteed, or a certain amount of money has been guaranteed to employees. But that was back in the old days. In the course of the past decades, there has been a significant change and an evolution to another form of benefit. So the benefit is now in more than 50% of all schemes a capital guarantee. A capital guarantee of the contributions that have been paid into the system. So that is the benefit. That is a huge difference to what we had 40 years ago, 30 years ago, 20 years ago, where you got this minimum amount of money as an employee, which they told you, yeah, you will get 3,000 Deutschmarks a month or something like this. So, but this is gone. This does only exist in very old contracts. So the new world of benefits significantly different from what we had back in the days. But it's still a benefit, so it's still kind of DB, and it's still, as you, Jonathan, and Justin said, it's the basic model in Germany for occupational pensions. So I have been asked to give you an overview of the shift that is taking place from defined benefit to defined contributions, which brings us to the questions of annuities and capital guarantees. So, and these two questions are in the center of the discussions in Germany on private pensions and on occupational pensions. So, but I would like to give you, first of all, an overview of a pensioner's income. How is a pensioner's income in Germany composed? And I would like to ask EFAMA Bernard to show the first slide. I only have 2 slides. That's actually the second one. The first one is this. This one. That's exactly the one I'm referring to. So, where does a pensioner's income stem from? So, 61% is the government pay-as-you-go system. You have to add the 14% in the orange field, because the orange field, that means this is the pension of civil servants and of some professions like medical doctors, architects, accountants, lawyers, for instance. They are forced to have a pension like this, and they are using me, for instance. I'm a member of the lawyers' pension scheme here in Hessen. And this is part of this orange piece with 14%. So this makes 61% plus 14%. You see the 15%, what is 15%? It's other income. In most cases, this other income stems from rent of apartments that are let to tenants. And this is one of these sources of income in the green field. And then you have only 8%. This is the light gray piece. Only 8% that stem from occupational pensions, and 7% that stem from private pensions, which is mostly life insurances and fund savings plans. This is to give you an overview of where a pensioner's pensioner's income stems from. So occupational pensions do not play the role that they deserve, and this is recognized by the government, and that's why they wanted to change it. And in 2018, the legislator introduced a new law in order to promote occupational pensions. And what they did was they suggested a scheme, they call it social partner scheme, where guarantees are no longer necessary. The caveat is, it's not up to the employer himself to introduce it. The employer needs the agreement by the labor unions. So if the labor unions and the employers agree on an occupational pension scheme that skips the requirement of guarantees, they can do it. So that was introduced in 2018. So almost 6 years ago, kind of 6 years ago. And what is the outcome? And that's interesting to see. There are 2 trade unions that are in favor of such a model. So the chemical industry already introduced one scheme, so the unions and the employers agreed on introducing a scheme without capital guarantees. And the second one is the banking industry. So the big question was, how would the very, very powerful trade union for the car industry, electrical industry, and steel industry, what would they do? And 2 weeks ago, they made the decision to reject it. So they do not want to skip guarantees. So it's a totally different picture depending on the industry we are talking about. That might not be their last stand. That might change over the course of the next months. but for the time being, they rejected such a scheme. So there is a slight development in the occupational pension sector away from from DB to DC, but it's very, very difficult to convince the labor unions, and that's why progress is pretty slow. So on the private sector, that is a very hot topic in Germany. You might have heard of Riester. Riester has been introduced in 2002. It's a private pension savings plan, mostly in life insurances, but also in some banking products and fund savings plans. It's subsidized by the government. There are 16 million contracts, which is not bad, but which is not enough either. And it became criticized due to the low interest rates. So it is, Riester is a product from the old days. In the old days, and I'm happy to say it's in the old days because we have a paradigm shift that is really dramatic. So in the old days, there was a dichotomy in German politics, a dichotomy between old age provisions and wealth creation. Old age provisions, that is something worth subsidizing from a government perspective, while wealth creation is something for the rich and beautiful, and there is no need for the government to step in. The requirement to qualify as old age provision was, first of all, annuities, and second, capital guarantee. So as a consequence, life insurance is qualified as old age provisions, and investment funds did not. So that was the old day. That is mirrored in Riester, and that is now challenged by a new report that has been made by a high-level expert group. So our incumbent government want to change the system. The return of Riester is due to the low interest rates and the capital requirement extremely low. So they say it doesn't pay off. It's a bad deal for the savers. We need to change it. All the parties in the government agree that there is a need for reforms, but they don't agree on how it should be reformed. So that's why they introduced a high-level expert group. It was composed of 19 people, among them 6 professors, high-level experts from the government, the industries, etc. And on the questions of the necessity of annuities and capital requirements, the outcome was that apart from the representative of the life insurance industry, all the others agreed that that should not be a requirement anymore. So the proposal now is to skip the capital guarantee requirement, to skip the annuity requirement. It's too expensive, and that's why whatever we will get, and as the government is running out of money, as you all know, maybe we won't get anything, but if we get anything, it will be stripped from the requirements of capital guarantees and annuities in the third pillar. And that is a paradigm shift. It's a sea change. It's the old dichotomy doesn't exist anymore. It's significant, definitely significant. Thank you very much for a first overview.
That's brilliant, Thomas. Thanks. And it's really interesting to hear about this paradigm shift. So what, if I'm sort of summarizing it well, the policy community is moving now and recognizing the importance of DC, but in society, significant parts of society is still very cautious, as expressed through those difficulties in the second pillar.
That is the interesting thing is with these trade unions, it is also depending on the average salaries that are being paid in a industry. So the chemical industry and the banking industries, they are well-paying, high salary industries, while some other, trade, for instance, retail, this is low money. This is not big salaries. So these people say, these trade unions tell us, listen, I mean, if that is at risk, they need every cent. If that is at risk and it's not guaranteed, we agree on a deal that we sacrifice some money today to get a return in the future. But we are not sacrificing money today to get less in the future because salaries aren't high enough. So that is a political question. It also depends a little bit on the industry.
Really interesting. Well, let's come back to some of that later, but continue our tour d'horizon around Europe for now. And let me invite Anne to say a few words. I think it's around 4 years, Anne, since the Loi PACTE was passed and which created the potential for France, which has also been more traditionally, I would say, leaning towards a protectionist sort of defined benefit model to start to reform. Where are we today in France?
Thank you very much for giving me the opportunity to promote what has been created in France, because we consider, all the professional and the regulators, that the PACTE law has implemented this new product, the PER, and is a big success. So maybe I'll begin with an overview of what is the PACTE law and what it has changed in the pension landscape, and then how we can mitigate the risk, or maybe it's more positive to say bring protections within the schemes itself and then within the investment more specifically. So the PACTE law is a kind of wide law, which means action plan for business growth and transformation, meaning that pension is just one of the pillars of this law. And what is interesting for us, specifically in France, because you know, as difficult it is to brainstorm around pension in France, pension is seen in this law as a lever for growth, economic growth for the country, for the whole country. It's not only to take care of the pension of people, it's as well to boost the economy of the country. This law created a new product. The name of the product is PER, meaning Retirement Savings Plan. What is really interesting in this new product is that it can be structured both in an insurance-based format, PER, or security account. And it can be as well both individual or workplace scheme. All the rules, all the features are the same in the insurance frame, in the non-insurance frame, in the retail universe, and in the workplace universe. And this is key because it creates a feeling of clarity. Maybe we can go to the second slide, in which you'll see the 3 types of PER. There is 3 types of PER. The first one is individual PER, in which contributions are made on a voluntary basis, most of the time with the support of an advisor or a bank or any kind of professional networks. So it's more on the wealth management side of our business. You have the second one, and so the PER was the last one, the last line. The PERCOL Workplace PER, it's a collective workplace scheme, which is offered in sponsored saving plans by a company. It's a collective approach which ensures to all employees, it's very inclusive, regardless of their roles, that they have access to a retirement savings plan with the same rules than in a very wealthy universe for in the retail business. And this PERCOL is commonly associated with employee savings schemes and benefits from profit-sharing inflows. The first one is really wealth management. The second one is really profit sharing. And the third one, the PEROB, the PER obligatoire, is compulsory when the company decided to set a scheme in its company for everybody, which is designed for this plan, but the company is allowed to define a category of personnel. The one with profit sharing is for everybody, to be simple. The one which is compulsory when you select the people, you pay a premium, it's compulsory, it's not a profit sharing, it's a defined premium. This one, you can select certain category of people. So you have a big flexibility, and none of this PER are compulsory. It's up to the company or up to each of us in the retail area to decide to set up a PER. And for each of them, the rules regarding the tax and the contribution and everything are the same. If we go to the second page, and this one is really important, it's the figures are the one of last year, in fact, because it's December last year, it's a year ago. So we are now, the growth are continue at a very interesting pace this year. And you see that we have reached 80 billion euro. And the success is, of course, quicker for individual retail PER because they are easier to sell. It's just one action to sell it than for the workplace. But the growth is as well very interesting for the workplace and on the two schemes. Those figures, as it is non-compulsory for all the different savers, would it be in the workplace saving or in the retail universe, shows that this new PER have convinced the distributors, the employees, the employers, and in fact, most of the people who are saving in France. And most of the people have really understood the tax advantages, of course, and all the benefits coming from the new features that has been created in the plan. So let's have a look together at the different features. So I have no slides for the features. Or maybe there is another one. I don't know. Or maybe we can go back to the first one. The one, yes, this one. Thank you. So in each scheme, you have 3 compartments, and each of them is dedicated to specific inflows coming from voluntary paying or profit sharing or mandatory payment, as I explained before. And in each of them, even if you are a parent, per individual, you can gather in it all the inflows that has been created within your workplace scheme. So this is a new option that has been implemented by the law, which is one of consolidation and simplification. Before the PER, we all had different kind of very small schemes, and it was very difficult to gather all our savings in one and to manage. Because of that, it was really difficult to manage and even to understand what kind of benefit we could have with those plans. Now, this law simplified this by allowing individuals to consolidate their retirement within a single PER account, and they are free to choose the ones they want. And this consolidation brought clarity and simplicity, enabling everybody to better manage and control their retirement savings. This is one way to protect investment. Another way to protect investment is the flexibility. It's really key for the saving, and specifically when it is voluntary, and this is the case here. PER allows people to choose to contribute voluntarily to any kind of PER. For example, I have a PER in retail, and I have the 3 of them. And each time I make a personal contribution, I can invest in any of them, the one I chose. Flexibility is as well key for the pension phase, for the exit. That was as well one of the big change of the PACTE law. It improved individuals' freedom regarding exit retirement. We have now different options. We have fractional withdrawals, which means that I can withdraw whenever I want after retirement, and I don't have to program it. It's free. It's really free. I just take as I want the amount that I need. And in terms of security and protection, it's key because I'm free to decide when I will make the withdrawal, depending on the market and depending on my needs. You have, of course, complete withdrawals as well, the traditional lump sum, and annuities. And within annuities, you have many different kinds of guarantees. So whether opting for a lifetime annuity, a lump sum withdrawal, or a progressive withdrawal, people have the freedom to manage their retirement income depending on their financial goals and preferences. And this is, it's not really a protection, but it's really one of the layer of growth of those schemes, because thanks to those new options, people are more comfortable to save in those voluntary schemes. Another key feature of not really protection, but which create comfort, is the portability. It goes with consolidation. You can, I said that you can gather where you want the different savings that you have and the different schemes that you have. And the regulation made it very easy, and there is a very big constraint on all the operators, would it be insurer or asset manager, to transfer all the assets very easily with no constraints, no delay, no fees. And it works very well. Really, it works very well. And all the asset manager and insurer have now changed the market, really. In addition to that, very important point are the exceptional withdrawal options that are included in the PRR. And for all of them, once again, it's the same, the rules are the same. So you have options which protects you in the sense that if you have some family event, life event, negative event, you can withdraw money. And there is a positive event, very important, which is the permanent residence purchase. If you purchase your house, whatever, even if it's not the first time, it has to be your house. And we know how important it is to have a roof on your head when you go to retirement. You can take your money from any kind of the PER, and it's immediate. You just have a paper to send to your operator and you receive the money right away. It works very well. It is as well one of the reasons of the success of this pension saving, because you save for your pension and you save for your house, and you have a tax advantage at the same time. And the last feature I wanted to explain is the ability to adapt the product. The PER is not only a standard product, it is a standard product in the way that the rules are very well defined and applied in the same way for all the PER. But within the product, you can design different options, and specifically on the investment side of it. And you can as well select freely for the company or for the saver itself, if it's in the retail business, the asset manager or the insurer that you want to work with, to partner up with. And of course, each scheme has its own specificities. So you have many different pairs in the French market today.
Right.
If we go now to the
Thanks, Anne.
Yeah.
Oh, sorry. Yeah, sorry. I thought I'm quite keen just to maybe come back to some of these issues later on and hear a bit more about the Italian situation, if we can. I think we've had a very interesting narrative from both Germany and France about the different journeys, different cultural journeys in many ways, towards a way of thinking about long-term retirement savings that would have been thought perhaps unthinkable 10 years ago, certainly 20 years ago. Ambrogio, where on the spectrum is Italy at the moment? I suspect you recognise a number of the themes that Anne and Thomas have already raised. But how would you describe the pension reform process as it stands today?
Yes. Let me first of all check whether you see my slides or not. Do you see them?
Yes, I certainly can.
You do. Okay. Anyway, let me first of all say a word, a very general word on from our perspective, but in very general terms, how we should anyway think when we look at how to protect pension savers in the DC context. First of all, we have to recognize the wide diversity that across countries, and in particular also across Europe, we have in the structure of pension systems. First of all, as different relative, as it refers to relative dimension of public systems versus private system, pay-as-you-go versus funded, and also DB versus DC. And this is obviously very much rooted in the way welfare systems are designed. So the issues in pensions always go very much beyond just protecting savers in terms of supervision, in terms of what is more familiar to us in terms of financial supervision or supervision about financial products that are sold to the market. Second thing, that there is also a wide diversity across possible DC systems, DC schemes, and just to make things in context, we at EIOPA in the discussions on the possible review of the EIOPA directive, it was very evident how different is the interpretation that DC schemes are given in Italy in comparison to what is done in the Netherlands. Just to make things clear, in the Netherlands, choice to members is basically not something that is considered desirable. In Italy, it is a very important element. And this comes from two things. One is the importance that in Italy we still have for the public system, where you have to put a lot of money. The Italian economy has to put a lot of money. Still, 33% of labor income for employees goes compulsorily to the public as-you-go pension scheme. And so we really want to give some choice to members when they put some additional money in the private schemes. While this is in the Netherlands, they have a very different situation. And what is very important is that these things are rooted not only in the design of the welfare systems, but also in the allocation of responsibilities that it was considered possible and appropriate by social partners. So just to be very clear, when the system, the DC pension system was implemented, was created, was put in place in Italy in the 90s, it was clear that trade unions from the side of workers, they wanted to have an important role, but they were not ready at all to get responsibility about the actual financial choices, about what was the appropriate asset allocation. They did not accept at any point some role to get to decide what was the appropriate, for instance, portfolio allocation for shares or for bonds or that kind of choices. And this has to be recognized in terms of how is possible to get political support in one particular context for private pensions and for the development of pension system and in particular pension systems where risk is put on members, so the defined contribution framework. So this is very important, and this has to be recognized at any level by EU regulation. Sometimes this is an issue where the recent EIOPA advice is not really consistent with, and we can go back to this later. Let me go more in detail on how the Italian system is designed. As I said, it comes on the top of an onerous contribution-based pay-as-go public scheme. And that is the reason why after 20 years of development, we still have just about one third of the workforce that is actually enrolled in the defined contribution private pension schemes, with wide differences across stronger or weaker layers of workers. It is a problem of affordability, basically, that once you put, as I said, 33% of the salary, of the gross salary already in the public pensions, it is difficult to put on the top of that a lot of money, or at least that is not possible for many workers. And non-profit schemes typically set at industry level by the initiative of social partners, so trade unions and industry and employers representatives, at the same level of regulation, with this, basically the same rule with schemes offered by financial commercial providers of products, so asset manager companies, insurance companies, and so on. This was the basic design.
We may be having a few connection difficulties.
On that point, regulation did not put strong rules, as it is done actually in different contexts. For example, in context like the Chilean one in Chile or in Mexico, I mentioned these countries because they usually are the ones that have had the longer probably experience in terms of having defined contribution systems in place. It is actually the national law at some point defined a kind of standard that is followed in practice both by the industry, the non-profit industry level schemes, and the products that are offered by financial providers. they are very similar. The structure in terms of choice architecture is very similar. They offer 4 or 5 investment options, typically a guaranteed option, then a bond-oriented, a balanced option, and an equity-oriented. The idea is that once these options are defined, the pension providers are obviously expected to match the actual investment management with the investment option that is offered to members. So this is basically the way the system is defined. So if I can say what is the approach of Italy in protecting members of DC schemes, is first of all defining an appropriate choice architecture, allowing so the matching of individual preferences and the needs of individuals with the investment option that they select. But once the investment option is defined, pension providers are expected to stick to the risk exposure that characterizes the investment options offered to members. And then the other point that is very important is to favor cost-efficient solutions for investment management. This is actually, I would say, very well implemented in the non-profit industry-wide schemes. There are probably improvements that are possible for schemes that are offered by commercial providers. On this aspect, we had long discussions at the EIOPA, and we, in the context of the advice that was given by EIOPA to for the revision of the EIOPA directive, and this actually is an aspect that was not fully taken into consideration, and I think this was a mistake and this is a mistake that will have to be reconsidered once the EIOPA directive will actually be discussed for review at the level of the European Commission. One last thing that I would like to show you that I think fits very well in the discussion that was already made, in particular by Thomas, talking about the German system. This is what I put on the screen is are the returns that we observe in the last 10 years for the 4 most typical investment options that are offered by Italian industry-wide pension schemes. So the four options that we see here on the screen are the guaranteed, the bond-oriented, the balanced, and the equity-oriented. And you see that the equity-oriented, what you see are the range of different returns that were actually achieved by the pension schemes that are actually offered in Italy, in the Italian system. You see that the equity-oriented all were, or almost all were, in the neighborhood of 5% in terms of nominal return, nominal annual return, average annual return for the 10 years. And you see that the guaranteed schemes offered a much smaller return. That is the main issue that has to be considered by the representative of workers when the discussion about guaranteed or non-guaranteed investment options are considered, because the point is that guarantees do not come only at the expenses of the guarantor, that obviously takes a responsibility for the offering the guarantee, but also it is very important in terms of conditioning the way money is invested. It is not possible to think about a scheme that, for instance, has a significant exposure in the equity market, if you want to, at the same time, to offer a guarantee. So that is an issue that should, in my view, move the preference of workers and of members and also representative of workers in the direction of non-guaranteed scheme. This is going to be in the long term in the interest of members.
Thank you.
Yeah, I think I can stop here that for this round. Thanks.
Thank you, Ambrogio. Well, I think from Thomas, from Anne, from Ambrogio, we've had a really interesting tour of Europe, really exploring what I might sort of summarize as the delicate and sometimes intricate regulatory and public policy journey towards greater responsibility and choice that comes with defined contribution. But I think I'm right in saying that in all three jurisdictions, a journey now that has started, it is moving at different speeds, but it is a journey that is going to continue. I think this is the message that I'm taking from that. Ambrogio, you mentioned some observations that you had about the EIOPA guidance. I'm conscious that I don't want to sort of turn this into a discussion sort of specifically about that, but I'm very interested just to hear, just in your reflections. Obviously, you're taking an EU-wide view. It's not EIOPA's role to give a view on any single jurisdiction, but what have been your takeaways from what we've just heard over the last 40 minutes or so?
Thank you, Jonathan. And indeed, as you say, what we hear it reflects the diversity of pensions in Europe, and that the journey that Thomas describes is different from Anne, is different from Ambrogio. But actually, I mean, a common theme is at least the possibility of a more DC type arrangement, even if in the German case, not so many are keen on it. I mean, if you want me to go back to what Ambrogio was saying, I think it goes back to what I said, that those who run defined contribution schemes need to understand the risks. And I mean, this is something which the EU supervisors kind of don't find controversial, and of course want to emphasize in their advice, and that part of understanding the risks, if you're responsible for members' well-being in retirement, is understanding what is the risk tolerance of your members, what might they be projected to have as retirement income on a kind of cohort basis. I mean, this is sort of this is what is meant by long-term risk assessment, and from a supervisory perspective, it seems to me to be entirely sensible. Thank you.
Thanks, Justin. One sort of word that hasn't really come up so much yet, but is perhaps implied in some of our discussion is one of trust, trust and confidence on the part of those who are looking to the investment management industry, to insurers, to other financial services providers to look after their money, and how we strengthen trust in investment solutions. And you talked a lot about the popularity of the new plans in France, the element of control, flexibility, comfort that comes with that new way of saving. Do you think that we have been successful in starting to build trust in those more high-risk investment solutions that, nonetheless, as Ambrogio's last slide showed us, we need people to invest in if they are to get the kind of returns that they need over 20, 30, 40 years? Oh, you're on mute, Anne.
I said yes. I don't think so. And we just discussed the design of the PER. It's important as well to keep in mind the way the regulator organizes the investment rules for the PER. And for the PER, you have the main innovation of the law was to implement a by default option with a glide path, a life cycle of a fund, which is not something very new. But what is new is to have a by default option, and the same one for the different PERs that as I have described, to include in the life cycle illiquid assets as diversification, to fix some rules, to define 3 different profiles. And the regulator have defined the threshold of prudent asset and dynamic asset between prudent, moderate, and dynamic. But it's just threshold, and it's up to each of the operator, asset manager or insurer, to design its own path of allocation proposed for the horizon funds. The only obligation is to have a by default, which is a life cycle, and to propose at minimum 2 life cycles solution with 2 different risk profile. And of course, all the operators are providing the 3, because it's now a market requirement. And it created a lot of trust, I think, and easiness in the use, in the understanding of the scheme. In the regulation of the PER, going with the different profiles, there is risk profiling, which is a tool with very simple, and this is not new as well, but it's very efficient. With very simple question, you can understand which is your own profile. If you are prudent, most of the people, they don't know it. And if we go back to the different PER, the retail one is one which is most of the time set up with an IFS or an advisor, which help the saver to understand and to choose. But most of the collective, the one coming from profit sharing workplace schemes, for most of the savers, it's the only and the first saving plan they have. And you know, French people, unfortunately, they are not very keen in investing. They are not very used to it. And it's a way to educate. And this is as well one of the benefits of this law. As you have seen the success of and the number of employees and the number of individuals is growing, all those people are equipped now with an app. And this app is showing the value of the saving and giving them all the needed digital tools to manage their saving. And on a long-term period, it creates a big trust. And more than that, it creates for French people, which are not the first one in Europe, a progress in their understanding of the markets and of the need to invest. And maybe just a quick word on ESG and illiquid, because within the PER, it is compulsory to offer ESG and illiquid. And that as well is something which helps people to better understand why those expertise can offer them a different option.
Thanks, Anne. That's very interesting. I just want to take a quick reflection from Thomas. We're going to try to move on to retirement income, which creates some major trust issues as well as practical issues. But I'm very interested in those comments, Anne, about how French society, which, as you say, has not traditionally been as favourable to investment as perhaps some other parts of Europe, how that sentiment has shifted. And I think, Thomas, we discussed already that Germany, in some respects, German citizens have also perhaps been less historically favourable to taking the kind of, certainly, equity market risk that is required. What are your reflections on this question of building trust and confidence, particularly on the Riester side? Oh, you're on mute as well. Did you just answer yes? Still on mute, Thomas. Sorry, we can't hear you.
Oh, I'm sorry, Jonathan. I'm sorry, Jonathan. I was about contradicting you. Maybe it was good you couldn't hear me.
That's why we had you muted. We
I
don't
was-
want any contradictions.
I was actually defying your theory about the reluctance of Germans to invest in equity. Actually, if you have a look at the assets under management of our members, 2/3 are in equities in the retail world. So the institutional world is much more fixed income oriented, but in the retail sector, 2/3 of all assets are equities, and then followed by fixed income and properties, actually. So that is, so in the retail, in the private pension business, this is not actually the case. But trust is of course a huge issue. So let me come back to, in the political arena, this shift from away from guarantees and annuities, I think this is perfect. This cannot be made undone in any case. So even though the insurance industry is still resisting, I think their case is pretty much lost. On the occupational pension. So when this law I was talking about, the social partner model, was introduced in 2018, the trade union said, listen, the old DB schemes were good for us. We knew the outcome. It was pretty secure. And now you expect us to renounce guarantees. You expect us to renounce employer commitments. So what's in for us? What do we get in return? It's a bad deal for us, just moving to a defined contribution. So, and the compromise was that there are two requirements to be met. The first one, of course, it's the agreement of the trade unions. So there is no DC scheme can be introduced without the consent of the workers' unions. And the second is that there is a requirement for contributions from the employers. So the employers have to put their own money in. And this is, of course, enabling capital buffers. This is enabling reducing investment risk. This is enabling the funding of, or the adoption of more conservative investment approaches. So, and that is kind of a compensation for the workers' side to get a bit more safety net, a bit more security for the investment outcomes.
That's really interesting, and always very happy to be contradicted by you, Thomas. And I definitely learned something there because I wasn't aware. I should have been, of course. Talking of guarantees, of course, takes us very much into the retirement income space, and something that is of critical importance. And I was interested, Justin, that EIOPA does clearly differentiate investment risk and retirement outcome when it is thinking about its sort of 5 risk framework. And perhaps I could invite you to say a few words about some of the concerns that you have in the retirement income part of the sort of DC universe, and then I'll come back to colleagues from around Europe for some reflections.
Yeah, thank you, John. I mean, I think in one sense, if the investment risk crystallizes, then the retirement income risk will crystallize. I mean, sometimes it can be different in the sense of, say, running out of money before you die, but it can also be not having accumulated enough because of investment risk then leads to retirement income risk. I think that from the perspective of a supervisor, I mean, I think that there are some things that are important. One is that these things be properly measured. And so, particularly where there are guarantees involved, I mean, that pension funds should not delude themselves about what is the level of their liabilities and assets. I mean, you see, for example, that defined benefit schemes around the EU measure their liabilities in a range from 0.4% below the risk-free rate to 3.1% above it. And this makes a huge difference in terms of what would be the measured liabilities of a pension fund. Now, I mean, it's never good for a pension fund to be underfunded, but even worse, in my view, is if it is underfunded but is deluding itself that it's sufficiently funded. I mean, this is the kind of worst sort of outcome. So I think measurement is very important. I think that the right sort of information is also important, and therefore we in EIOPA we have put a lot of emphasis on tracking systems, pension tracking systems, giving individuals the ability to understand what they have accumulated and what that might be projected to become in terms of a pension. And this requires elements of standardization. Well, it requires the presence of data, the standardization of data. It requires a kind of a governance structure which is acting in the interests of the members, all of these things. But particularly as we move into a DC world and more the risk is on the member, something like a tracking system becomes more important. We've also emphasized pensions dashboards. I mean, which we mean by that a more kind of macro approach, so looking at the overall adequacy and sustainability of a country's pension system. And again, I think that as you move to, if you're interested in retirement income risk, having a dashboard which sets out the overall position of a country's pension scheme is useful to as part of the consideration of that risk. Can I just say something else? I mean, you talked about trust, and I think that this is also important. I mean, actually, that good pensions management requires sort of concepts like trust and solidarity, which aren't always kind of in fashion. But the moment you move away from something which is pure DC, something which is just an individual's own investments, you require kind of elements of trust and solidarity. I mean, in terms of as soon as you have some guarantees, there is the question of who bears the pain when the guarantee is called upon. And you can see different results in different countries. I mean, I would say that in the UK example, it has been the young who have borne the pain. That actually, in order to afford to pay DB benefits, these have been closed, and younger people are in inferior DC schemes. Not inferior as such because they're DC, but generally the contribution of the employer is reduced. In the Netherlands, you see probably what you might call a more collective approach, where it is contemplated that both active members and indeed pensioners can take a hit if needed. And you can see that these things, that the protection from retirement income risk requires this kind of trust and solidarity that you refer to, but also that it is quite a cultural thing. I mean, it is as a kind of society as a whole to decide the extent to which you want individual as against collective solutions. And from a supervisory perspective, I mean, you need to have confidence in whoever is providing your pension. So it is important, as I said, that the balance sheet of the pension fund is correctly identified, that people have confidence in those who are governing the pension fund. I mean, these things are very important in order to kind of facilitate the trust that you refer to. Thank you.
Thanks, Justin. It's a very interesting discussion, actually, and probably one that we don't have time for today, where solidarity sits in a defined contribution system. certainly a pure defined contribution system. I certainly take your point about some of the different cohort experiences in different jurisdictions, and we can see in the UK the overall difference that those particularly younger cohorts in DC are going to experience. And Boji, I wonder if I could turn to you to get your reflections, not just perhaps on the sort of Italian context here, but more broadly on this idea of how we get the right balance in DC, particularly in retirement income, where we are managing money in a way that is not inherently about sort of communitarian solidaristic principles, but actually much more related to how we can ensure that investment markets deliver most effectively for individual savings pots.
Yes, no, thank you. This is a very tricky. I believe that there is a kind of consensus that it is possible to design in an appropriate way the accumulation phase of defined contribution schemes. As I said before, there is a range of possibilities that goes from giving a lot of choice to members and or not giving choice, as I was mentioning, as different models, the Italian model and the Netherlands model for the accumulation phase. And just to make a reference, if you go to the work of OECD, there is this recommendation on the good design of defined contribution pension schemes that is very convincing, I would say, and it is a very good piece of work and a reference, very usable, and I believe actually used reference.
Oh, I think we're having a few difficulties, Amber. You might want to turn off your video if the connection is giving a problem. I had a similar thing earlier.
I don't think that we still have a consensus view that on which is the best solution. And the main reason for this problem, this difficulty in getting a solution to that problem, in my view, is the inherent characteristic of annuities, that because the life expectancy is inherently correlated positively with income and wealth, basically introducing compulsory annuitization is a policy that has a regressive feature built in the requirement, basically, and it is very difficult to correct that element of regressivity. Frankly, from the point of view of policymaker, the easiest solution that would be, because you want to protect people from longevity risk, you just insure, you just require people to be insured from that risk. That would be very easy. But the regressive nature, the correlation of life expectancy with the income and wealth may.
I think we've lost Ambrogio, but I think
in which we are exploring. I think we are in a moment in which, in different fora, we are exploring different possible. I would say not really solutions, but probably a combination of possible solutions or options that could be offered that somehow could be acceptable in different situations. But I don't see actually really a recommendation that can be done and should be applied in all cases.
Thanks, Ambrogio. I think that very much reflects where we are in the UK. And I think just to put the question back to Anne and Thomas quickly as we enter the last sort of few minutes of this webinar, I think if I understood well what Ambrogio is saying is that again we have left a world where retirement income is going to be, at least in terms of the non-state provision, a world of guarantees and annuities, but that we need a degree of flexibility because there is no single solution or no single sort of set of solutions that will provide for everyone's different needs, particularly in different jurisdictions. And would you agree with that?
Yes, I do, once again, because when we look together at the success of the PER in France, we all understood that this trust, the success comes with the trust, and the trust comes with all the different features that we have gone through. The one designing the scheme itself, the one protecting the investment, and maybe in addition to that, an improved communication and education on the need first, and how to do it, which is something that has to be done in each country, because in each country it's different. So this is as well one of the elements of diversity in Europe, the financial education, the pension sensibility is not the same in each country. And in a country such as France, where maybe if you have an average wage in France, the first pillar gives you something like 70–80% of the level of revenue, the same level of revenue, 80% of the last revenues that you have when you were working. So it's not the same than in the Netherlands, it's not the same than in the UK, it's very different. So diversity in the setting of the different schemes is very important, and simplicity. When it comes to investments, it's for everybody in all different markets is the same. Simplicity is key. If you go to too complicated mitigation risk models, things like that people do not understand, it's a way to lose the trust, or to lose the trust.
Thanks. I see Ambrogio wants to come in, so I'm going to bring him in very quickly, and then I'm going to go to Thomas for our last word.
Yeah.
Ambrogio.
Yes, thanks. No, just to fit all countries, as I was saying. Italy is different from the Netherlands and so on and so forth. But I think that we do have criteria to say what is good for in each case for every country. That is my issue. I think that, for instance, Netherlands are happy about their system. Probably we are happy with ours, and so on and so forth. Issue that in which it is not only the difference between country situations, but also the inherent issue of ensuring the security for life to layers of people that are in every country in different situations. So the problem of having a diversity and correlation of length of life expectancy with level of wealth and income. This is a feature of every country, but it is very difficult to offer an equitable solution in every situation. And I don't think that we are very close to having to fix this issue in a very satisfactory way, frankly. Thanks.
Thanks, Ambrogio. Last word, Thomas.
Thank you, Jonathan. I'm always shocked when I hear figures from France. And Anne just told us that a French pensioner would get 80% of his last wage out of the pay-as-you-go system.
For
80%?
salary, 80%.
How can you afford this? I mean, other people get 48%, 48, and the system is already overstretched. I mean, 80 is just kind of a fantastic figure. No, the question of annuities, lifelong annuities, or I think this is less a question of trust, because if you ask a 30 or 40 years old worker if he's interested in a lifelong annuity or be happy with cash out phase until his age of 85, most of them wouldn't care. This is more interesting for the government, as the government cares, because the government is afraid of having to step in when there's not enough money left for people that get in this system too old. I mean, at least older than the cash out plan. So it's more a political question, I think, than a question of trust.
Yeah, no, I think that makes a lot of sense. We're coming up to the end of the webinar, and this has been a fascinating discussion. It feels like we're only really getting started. Just by way of finishing, I'd like to just ask, and this is just one sentence only, please, to Thomas, Ambrogio, and Anne. If you could have one policy measure from the European Commission, and they would grant your wish to make a better European pension system, what would it be? I'll start with Thomas, because
with me
he's got some interesting views.
Yeah, but that is a very difficult question, as
repeat the question, because we didn't get it.
Was it Ambrogio's or my turn?
You can blame Bernard for wanting to finish on an interesting note. But Justin, you wanted to have a quick say.
If you allow me, you didn't include me in the list, and I understand.
Oh, no,
we have the right to advise EIOPA.
Yeah.
I would simply repeat actually what the chair of EIOPA said the other day at our conference in relation to dashboards, pension dashboards, that no matter how difficult it might seem to governments, to policy makers, to collect the relevant data, we cannot close the pension gap without accurately measuring it. And for that, we need the data in one dashboard. So if you ask me for kind of one wish, I think that would be it.
That's a great one. To make life easier for the others, because I'm conscious we've put you on the spot. Would you agree with that?
Sure.
And apologies, Justin. The only reason I hadn't come to you was just because I'm conscious that with different policymakers and regulators, sometimes you don't necessarily want to kind of come out in public. But I certainly think that's an excellent one. I know different jurisdictions across Europe are in different stages of working on that, and certainly data is something that has always been a problem for everybody to move forward. So Why don't we end there actually, because I can sense that probably that's a question too far for all of the panelists. Let me thank you very much indeed, Thomas, Ambrogio, and Justin. It's been a real pleasure as always. I think we've got a lot more to come back to in a future European Retirement Week. I hope everyone who's listening has enjoyed the conversation today, and we'll look forward to seeing you at future events. Have a good rest of the week. Thank you.
Thank you.
Thank you very much. Thank you very much. Bye-bye.